Have you ever thought about your investment portfolio like a finely tuned orchestra, where each instrument plays a specific role? What happens if some instruments start playing much louder than others, throwing everything out of sync? Well, if you do not rebalance your investment portfolio, it will gradually drift away from your original target allocation. This means that the mix of your investments, such as stocks and bonds, will no longer align with your carefully planned risk level and financial goals, potentially exposing you to more risk than you intended or limiting your growth. The reason this drift occurs is simple. Different asset classes do not grow at the same rate. Over time, some investments, like stocks during a bull market, might perform exceptionally well and become a much larger percentage of your overall portfolio. Conversely, other assets, such as bonds, might lag behind or even decline in value, shrinking their proportion. Without rebalancing, your portfolio can become heavily weighted towards riskier assets, or miss out on opportunities if it becomes too conservative, moving you farther from your initial strategy. Understanding this means you need to periodically review your portfolio's current asset allocation against your ideal plan. For example, if your goal was to have 60% in stocks and 40% in bonds, but now stocks make up 75% due to market gains, that is a clear sign of drift. While you do not necessarily need to rebalance constantly, knowing how to identify this imbalance helps you recognize when action might be needed to realign with your long-term objectives. This phenomenon is often called asset allocation drift, and it is a silent but powerful force that can undermine even the best investment strategies if left unchecked. Many investors fall into the trap of set it and forget it, believing their initial allocation will hold steady indefinitely. However, market dynamics ensure that your portfolio's actual makeup will almost always deviate from your target. By recognizing this drift, you can actively manage your exposure to market fluctuations and ensure your investments continue to serve your personal risk tolerance and time horizon. Ultimately, failing to rebalance means you are leaving your financial destiny to chance rather than active management. By understanding that your portfolio will naturally drift, you gain the power to make intentional adjustments. This helps you consistently manage your risk and stay on track towards achieving your most important financial aspirations, giving you greater peace of mind about your future.